Hey everyone. Warren Buffett, the legendary investor from Omaha, has two stocks in his portfolio that make up 47.4% of the overall portfolio. Now, normally I would not recommend anyone hold that kind of concentration of their portfolio in just two stocks, but most of us are not Warren Buffett, and most of us don't have the stock picking skills of Warren Buffett. Now, if we did, then I would have no problem with investing nearly half of your portfolio in just two stocks. But for most of us, what I would recommend and what finance theory would recommend is that you hold at least 20 stocks in your portfolio and you spread your investments out evenly, roughly evenly between those 20 stocks. Nevertheless, Warren Buffett has chosen to hold a very concentrated portfolio that works very well for him. So in this video, I'm going to talk about Warren Buffett. I'm going to talk about these two stocks that make up nearly half of his portfolio, why he holds these two stocks, or why I think he holds these two stocks, and the best part is I'm going to answer if these two stocks are worth buying for the rest of us or those of you watching, if the stocks are buys right now. So stay tuned and let's begin. So if you're wondering why we should even care about Warren Buffett and Warren Buffett's stock picks, well, one reason could be his legendary returns over the last 50 years or so. Another reason could be just to look at the returns in the last decade. I have here pulled up Berkshire Hathaway results, the price change of the Berkshire Hathaway A shares in the last 10 years are up 208.7%. So if you invested $10,000 in Berkshire Hathaway shares, which is the holding company that Warren Buffett manages, you will have tripled your money, right? Pretty good return in a decade to triple your money. And if you go back longer term, you will have had much even better results. So Warren Buffett, one of the best investors of all time, it's understandable that investors are interested in his stock picks and digging a bit deeper to understand why he's chosen the stocks that he has chosen. So let's start and let's look at the two stock picks. Those are Apple and Coca-Cola. These two make up 47.4% of Warren Buffett's portfolio. The bulk of which is in Apple stock, a smaller percentage is in Coca-Cola. But if we look at these two companies, and let me go out longer for the last decade, what you see from them is a pretty high level of revenue, and one of them you can even see very nice revenue growth. In Apple, you see revenue increasing from a little less than a little over 30 billion quarterly up to 117 billion. Now these jagged fluctuations you see is because Apple has a seasonal business, right? Of course, the holiday season being its most popular season, that's when people like to gift a lot of Apple's products. And so you see sales jump in that season and then come back down and then jump again. But over the longer term, you could see a nice upward trending there. Coca-Cola, you might get a little discouraged from the decreasing revenue you see from Coca-Cola here. That's partly due to divestitures. Coca-Cola will sometimes make big acquisitions and then make divest in those companies, and you see revenue come down as a result. Over the longer term, organic sales for Coca-Cola, just the core business, it's been growing at very, very low single digits for the last few decades. So this is not a fast growing company. And it's, quite different from Apple actually. Apple is a tech stock and Coca-Cola is more of a consumer staple, right? Warren Buffett is likely attracted to these two for different reasons, right? Apple more for its ability to innovate and sell products at premium prices. Coca-Cola more for its ability to become a consumer staple and generate billions in sales regardless of economic cycles being good or bad. You're still likely going to buy Coca-Cola products. The more important reason why I think Warren Buffett is attracted to these two stocks is their profitability. You look at the operating profit margin of these two stocks, we go back the last decade, and there is fluctuation to be sure, but for the entire previous decade, both Coca Cola and Apple have generated 20% operating profit margins on a trailing 12-month basis. In other words, annually, they generate a 20% or higher operating profit margin. That means sales and then all of its costs, they generate more than 20%. So the companies operate very effectively. They generate robust profit margins, and this is through economic cycles, good and bad times. They're able to do this because they sell products that consumers want, that consumers are willing to pay premium prices for, right? You're willing to pay the higher price for the iPhone versus any other phone in the market. You're willing to pay the premium price for a Coca-Cola beverage versus the other generic store brand beverage that's on the shelf, right? You're willing to buy Coca-Cola over that other store brand soda. And you've been doing that for decades now. And that's why Coca-Cola is able to generate very nice profit margins. And Warren Buffett likes companies that generate very good profit margins because as a shareholder, you are entitled to a share of the company's profits, right? You technically get a share of the company's profits, and companies pay that to you in the form of dividends. So the better the profitability, the more dividends are likely to come out of the company in the long run. Similarly, these companies, when looking at the amount of sales that turn into cash flow, are also very good at this metric. If we go back the last decade, again, very healthy, very robust cash flow from operations to sales. So it's not like these companies are generating profits but not cash flow. Sometimes companies can do that because there are these things called non-cash expenses. Think of things like depreciation or stock-based compensation. These are not cash expenses. So that can sometimes hide what's really going down underneath the company's financial results. That's why I like to look at cash flow from operations as well as just operating profit. And looking at this, you can see Apple and Coca-Cola do an excellent job in this metric as well. So finally, to answer the question, now that we know why Warren Buffett is attracted to these stocks, should they be in our portfolio? Are these two stocks that we should buy? And to make that judgment, I wanted to look at the valuation. Are these stocks expensive? And the answer is no, they're not expensive. What I have here is the forward price to earnings ratio for Apple and Coca-Cola. Apple had a forward PE of 25.8 and Coca-Cola at 22.77. These two stocks are not expensive. So if you would like to hold them in your portfolio and follow the Oracle of Omaha, Warren Buffett, you can go ahead and do so. Not feeling bad about this decision at all. Now, the stocks are not cheap, but they're also not expensive. They're fairly priced. And Warren Buffett likes to say you can make a lot of money in the market buying excellent businesses at fair value, right? You can make a lot of money just by buying excellent businesses and paying a fair price for them. You don't have to try to get a bargain price for every stock that you buy. So there you have it. I hope you enjoyed this video. I really enjoyed making it. And if you did and you want more content just like this, please subscribe. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.